Equity markets have begun the year on a very encouraging footing. So in this video, I'll set out why we believe there is plenty to support markets in the year ahead, how market leadership is rotating, and I'll cover off some of the risks we're managing to help you fulfill your financial ambitions. As I record this video just before the end of January, UK equities are up 2.5%, European equities are up 3.5%, and Japanese and East Asian equities have led the way with gains of over 5% since New Year's Eve. In those markets, that's been led by the AI-related plays as investors are more circumspect on the valuations of US technology darlings, but remain strongly supportive of the AI story itself. Indeed, market returns are broadening out beyond the technology giants. Versions of the US or European market indices in which all stocks are equally weighted have beaten the headline indices in which larger firms have more weight. We continue to allocate favourably to sectors such as industrials and healthcare. This broadening out of investment returns fits with our base case that I ran through in my video at the end of last year. To recap, equities are set to benefit from monetary easing and robust earnings growth, especially in technology and rate-sensitive sectors. While valuations are rich, the outlook remains constructive if recession risks are avoided. And in the US, growth may slow early in 2026 as tariffs push inflation higher, squeezing household spending, but this should be short-lived, and our recession risk models have actually fallen, and we estimate the chance of a US recession in 2026 at about 1 in 5. Relatively low and stable energy prices, and increasing willingness for banks to lend, tight credit spreads, easy fiscal policy, rising household wealth, and AI investment spending add support. Now, since the end of the year, the market consensus has continued to revise earnings expectations higher as the first set of companies to report profits this quarter are beating expectations by a little more than normal. Just as the number of stocks beating the index is broadening out in January, this so-called earnings momentum is broadening out too, with the majority of companies benefiting from positive earnings revisions in most regions for the first time since 2024. This goes hand in hand with continued economic improvement. Economic data has beaten expectations in January in most regions, with the exception of the UK and China, where we continue to remain somewhat downbeat on domestic prospects. Now, alongside my usual Outlook video, in December we also published a video looking back over the year for some key lessons. My first lesson from 2025, which was the same one that headed our list in 2024, was that we shouldn't underestimate how resilient global markets and the corporate profits that underpin them can be in the face of political and geopolitical uncertainty. And January has reminded us of that again, as President Trump has broken international convention in Venezuela and threatened military intervention in Iran and even Greenland. Despite that, markets have performed very well. Remember, over the last decade, we've dealt with a global pandemic, war in Europe, and the permanent remapping of global energy supplies, rates of inflation not seen for almost half a century, and profound trade wars. And throughout all of that, markets have delivered strong returns. Patience, diversification, and a clear process has been rewarded, and we continue to manage risk actively, investing with discipline, keeping your financial goals at the heart of everything we do at Rathbones. Now, it's important to remember that the USA has a long history of operating with questionable international legality, from the CIA-led coups of the 1950s to Nixon's secret bombings of Cambodia, or Reagan's Iran-Contra affair, which also broke domestic law, or the circumvention of the UN when the US invaded Iraq. Domestic corruption that's as old as the Republic, as are violent federal agents stoking civil unrest, from the scandal of 1932 where the army violently cleared out protesting World War I veterans, or the COINTELPRO harassment of civil rights and anti-Vietnam activists in the 1960s. What matters most for long-term investors is that we find no evidence these episodes or any period of 20th century civil unrest have had a lasting impact on market performance in the US. Now, what might be different today is that instead of hypocritical leadership, we have more outright defiance of domestic and international rules, antagonizing allies too. That could lead to longer-term institutional decay, potentially affecting the premium paid for investing in US assets, at least relative to other markets where institutional reforms are heading in the right direction. But such changes evolve slowly, and we build them into the long-run assumptions behind your strategic asset allocations. As I've discussed before, our analysis does not lead us to subscribe to ideas of an accelerated de-dollarization, whereby the world suddenly walks away from the greenback, The dollar acts as a haven and is chosen as the dominant reserve currency because of its enormous role in global debt and trade financing markets, not the wisdom of US policymakers, and in fact often in spite of them. Over the last 2,000 years, we've had the Roman denarii, the solidus and dinar of the Byzantine Empire and Islamic caliphates, the Venetian ducato, the Spanish real, the Dutch guilder, sterling, and then the US dollar. No reserve currency lasts forever, but their status is always determined by their importance in global trade, importance in global finance, and the network effects that stem from this, which go hand in hand with institutions that promote a sense of trust. Now, one of those institutions is a relatively independent central bank that supports the dollar-based global financial system. Independence is a relative concept in central banking, but you can see from this chart how strongly central bank independence was associated with inflation outcomes for 15 major countries during the inflation of the mid-20th century. Strong institutions provide a strong backstop that prevents spiraling prices. Now, to be clear, if the Fed loses some relative independence, the impact may well not be felt overnight. Institutions matter, but they're probably not great market timing tools. But the impact could be felt enormously the next time the Federal Reserve needs to tamp down on inflation, and is another reason why we favour relatively shorter dated bonds less sensitive to these forces in our balanced portfolios. We do factor in a moderate devaluation of the dollar into the long-run assumptions that determine the strategic asset allocations suited to meet your particular financial needs. While a few of the worst weeks in equity markets during Trump's second term have also been accompanied by a decline in the dollar, emphasizing the prudence of diversification across currencies, it is important to note that the usual relationship, whereby the dollar does better when equities do worse, is still intact. As I've discussed on these videos before, we have decent weightings to UK equities, which have beaten global equities in sterling terms over the last 5 years, and we are also tactically bullish on European equities. We want that international diversification. Last year, lower quality companies with weaker profitability and balance sheets did well. This is rare. Our equity investment philosophy sees us tilt towards higher quality companies, as you know, because 70 years of data shows us that they persistently outperform over time. Now, when I first started advocating for the quality factor a decade or so ago, it was less widely known outside of quantitative investing circles. Today, it is more widely understood and is important to complement this quality tilt with a focus on valuation, on not paying too much. At Rathbones, we are constantly re-examining what strategies are working as markets evolve. We believe that higher quality companies with more robust profitability are particularly important to weatherproof portfolios as best we can against some of the risks discussed today. So as we start the new year, the backdrop for markets remains very supportive. Profit growth is accelerating. More sectors are participating in the equity market rally. There are risks, but they are balanced in both directions. At Rathbones, we continue to invest with discipline, drawing on evidence, experience, and a clear focus on your long-term goals. Thank you very much for your time today. I'm Edward Smith, Co-Chief Investment Officer of Rathbones Investment Management.